I feel a little bit like David versus Goliath here with all of these statistics saying what terrible investments growth stocks are in relation to value stocks. And perhaps we'll get a chance to explore the differences that some of the points that George has raised, which I think are remarkably interesting. George and I started at the same point, actually. Valuation, which we've come to believe that over the long term, growth in the stock share price is driven solely by growth in the company's earnings over the longer term. And over the longer term, those growth in earnings are driven by growth in the company's revenues over the longer term. I think it's fairly widely accepted. Almost everyone, everywhere is my quote. So the implication of that is really simple for retail investors or for any investor. And that is, if you want to buy a stock whose price is going to go up in the future, you really want to find a company whose earnings and revenues are going to go up in the future. Because growth in price is driven by growth in earnings, which is driven by growth in revenues. So revenues drive earnings, drive growth in share price. Now, if anybody in the room has a fundamental disagreement with that, remember I'm talking about over the longer term. I'd be delighted to share it if you'd share that with us later. So that's the starting point. So if you want to find the stock that's going to grow steadily in the present future, find a company whose revenues and earnings are going to grow. And a key point, which we've learned the hard way, is that you also have to establish that the company's earnings per share currently are not overvalued. Okay? That's a big caveat on the general rule that growth in share price is driven by growth in earnings. Provided that earnings are not currently overvalued. So, for me, my model of an ideal growth company, we depict on these charts, this chart, we call it a great growth company. And the reason I call it a great growth company is because if you look at the revenue profile, the blue line, see the revenue profile is long, steep, and straight. Okay? Now, I don't know of anything more important to find out about a company than its growth history of growing revenues over the longer term in the past. But what is a steep? A steep profile tells you there's a high rate of growth in revenue, right? These are plotted on semi-log charts. So if it's steep, it's a high rate of growth. If it's straight, it's consistent growth at that high rate, year after year after year. Okay? So, gee. If it's long, these guys just haven't gotten lucky, right? Luck doesn't endure this long. Not 10 years anymore. So, when you see a revenue profile that's long, steep, and straight like that, what does that tell you about the company? What does it tell you about the company? It tells you that they've got good products, doesn't it? People like buying these products. And more people are buying these products every year. So they got to be good products, don't they? And what else does it tell you? Besides having good products, what does the company also have? Good management. People who are capable enough to find the products that they can sell in increasing quantities year after year after year. Not only find those products, they make them, advertise them, price them, deliver them on time. So they're selling these more and more each year. So when you see a revenue profile, there's a tremendous amount of information in there about the company's products or services and the people who are running the company. Now, can you ever invest in a stock without looking at the company's revenue profile? What if that revenue profile was trending down? What if that revenue profile is going like this? And it does happen. What does that tell you about the products and the management? That they're in trouble. This is not complicated. When you see the earnings profile also track along with the revenue profile, what does that tell you? More about management. They do their job so good that they manage to grow their revenues or their earnings at about the same rate as their revenues. They're smart enough to do that, to figure that out. Remember the dot-com era? There were a lot of companies who had revenues but no earnings. What good are revenues with no earnings? Anybody in here own their own business? No. You just know that if you're not making money, you don't care about revenue. So you see a company that for 10 years has managed to grow its revenues and earnings at a high rate consistently. You know this is a good price, good management. And what is it? You want to know more. If the revenues and earnings profile are going down, I don't care what they do or who's running it. There's no track record of these guys being any good at it, or the products being any good. So that's why I call this a great growth company. When you find a company that looks, you don't have to, when I started doing this in 1987, teaching people about this, we had just a single sheet of paper. There were computers, there weren't databases, digital databases. People had to go to the libraries and get the annual reports, or right away to the companies and plot those lines. It's a big job. Today, you get it quite easily. But I can't imagine studying stock without seeing this. If it doesn't look like this, I said, show me the next stock. There are great companies, but not all great companies have great stocks. Now here is a great growth company that also happens to have a great stock. And what makes a great stock is where the... Am I losing the power here? Sorry. Yeah, I'm losing my batteries. Does anybody have a pointer? Treasure the pointer? Is this? That's okay. There we go. Okay. That's a few hands before I go. Left, right. So, what makes a great stock? Well, a great stock is a stock whose price moves up with its earnings, just like it's supposed to. Over the long term, growth in price is driven by growth in earnings. So you see those earnings profiles growing. These are the gray bars are the high fiscal year high-low prices. So if you see those price bars moving up with the earnings profile, you think, well, the growth investor says, I'm dying to get right? Because here is a company with great products, great management, and the price is behaving the way it's supposed to. As earnings grow, the price goes up. We measure valuation as price-earnings ratio. Sorry, this one. So the stock price versus stock valuation. Sorry, this is pretty basic. It sounds fun. It's always useful to refresh it. When you buy one share of stock, and you pay $50 for that share of stock, what you're buying, you're paying, the dollars you're paying is to own one share's worth of earnings. So if earnings are $2.50 a share, you're paying $50 to own $2.50 worth of those earnings. In this example, 2. Valuation goes different from price. Valuation is the number of dollars being paid to own $1 worth of the company's earnings. So in my little example here, if the stock is at a $24 price and its earnings per share are $2, then investors are paying $12 to become the owner of $1 of earnings. Okay, that's the price earnings ratio. I think that's the best definition of price earnings ratio. The price that people are willing to pay for $1 of earnings. For the market, I use that term. No. The market perceptions expectations for the size and certainty of those earnings and the earnings growth rate inspires people to pay $12 for every dollar of earnings. Now, even the size of the future growth and the uncertainty of the future growth, that's a forward-looking number. I think most price-earnings ratios, most people don't use a price-earnings ratio when they're looking at a stock. If the price you pay for stock is an inherently forward-looking concept, right? I don't care what the stock did yesterday for somebody. I care about what it's going to do for me tomorrow and the next day and the next day. So price is inherently a forward-looking phenomenon. Well, the earnings that you should use then in a price-earnings ratio, it should be a forward-looking earnings number too. We use, earnings for the next year. When we calculate price-earnings ratios. When selling stock, but so, and the work that I do is really comes out of the dividend valuation model. The Gordon model, I think, is referred to. The price is equal to the sum of all the future stream of dividends divided by K for risk minus G for growth. So, sometimes overvalued great companies, sometimes great companies get overvalued. As a matter of fact, from my rooting around in the stock market, I think most really good companies are overvalued. It's hard to find them not overvalued. And you can see it. Because what's the basic relationship? Growth in earnings drives growth in share price. Well, look at this company. It's a nice revenue profile, nice earnings profile. But you see what's happened here? Price bars, they were tracking along with the earnings profile, and then they started to grow faster. You see, if you drew a line through those price bars there, you can see a much steeper slope than you'd see for earnings. So what's that say? Price is growing faster than earnings. Well, that's not the way it's supposed to be. Right? Growth in earnings drives growth in price, unless people get wildly enthusiastic about a stock. If every broker on the street sends out a letter to a lot of customers, all of a sudden that stock, I want some of that. And up goes the price per dollar earnings. Up goes the valuation. So this is what you see. The valuation, this is the examples I've shown here are based on real companies. This one is on Whole Foods, the big deli operation over the United States and in Canada now. Canadian Western Bank, like this happens a lot. So here's a great company that I would consider to be an overvalued stock. So if I owned this stock, and I saw the prices starting to move up like this, look at the number of years. When those price bars detach from the earnings profile, you've got serious overvaluation. But the remarkable thing is, look how long it can last. It's like 1, 2, 3, 4 years. But overvaluation can persist. And you can see the price-earnings ratio. This is what happens to the price-earnings ratio. It goes up to that. If I didn't show you, I'm sorry, I didn't show you this. Then it's my perfect stock. The great stock. See the price moving up with earnings. Well, if you take the price-earnings ratio, it's just a flat line. It's a stable price-earnings ratio when growth in price tracks along growth in earnings. So I'm going to set first. Here, the price-earnings ratio is going, very high, very high. So here's a great company. I've characterized different types of overvaluation. It's a great company with short-lived overvaluation. See what happened? See those first few price bars? They're growing more steeply than the earnings profile. And then the market says, wait a minute, why are we paying 40 times earnings for a stock that's only growing at 15% a year? Okay? And in one fell swoop, boom, the price bar comes back to the earnings profile, and then tracks along again at the stable price-earnings ratio. The stock is once again a high-quality growth stock, a great company with great stock. See a little bump up here in the average P/E ratio and then straight across. This is based on Procter & Gamble. Great company, great company. Now here's a persistently overvalued growth stock. I call it a big growth company with a terrible stock. Why? Again, see back here, the price bar is going up for 3 or 4 years. Look how steeply the price is growing, while earnings are growing much more slowly. Okay? Price and earnings are out of whack. And what this is Walmart from 1996, actually. This is Walmart. So what did the market do then? They're paying 50. This is about a multiple of 50 times earnings for something that's growing at 15 and 20%. Okay? The multiple is 50. So what does the market do? Walmart this time's got like $200 billion in revenue. The company's not going out of business. Probably every institution in America owns it. So what does the market do? They didn't immediately correct the price of the stock. Instead, price bars just move sideways. We have the high-low price bars, fluctuations throughout the year for all kinds of liquidity reasons for different investors, and noise, scares and things like that. The price bars just move sideways well, in this case, 1, 2, 3, 4, 5, 6 years. But what is that doing? With the price bars moving sideways, note that earnings are still growing. What's happening? What's happening? Price-earnings ratio is coming down. Right? Price is not going anywhere. Earnings are going up. The valuation is coming down. George made the comment earlier that, something with the price-earnings ratio not being forward-looking or being inversely related with something. I'm sorry, George, I don't want to misquote you, but the idea was that the price-earnings ratio was inversely related to something. I'm sorry? To return. Well, I would suggest that this just refutes that, because what the market is doing is simply taking, there's no growth in the share price, it's simply taking the price of the valuation down to a more sustainable level, something more in line with the company's growth rate. And sooner or later that will, those price bars will start moving up again with the earnings profile. But the market is very aware of valuations. They just don't do anything violent in this case. Because of the particular nature of the stock. See the valuation of that valuation going down again? It's still going down. It hasn't leveled out. So would you buy this stock? I wouldn't buy this stock as long as the valuation is dropping. Anybody who's bought this stock over the last several years hasn't had money. Get the little dividend. So high-paying multiples go away, okay? Because the market stops raising the price. And you wouldn't want to buy this kind of stock until it levels out, until we see the multiple reconnects, as it were. Here's an even worse stock. This is Home Depot. I said it's even worse. Did you see the earnings growth? You see the price moving up like this so steeply again, and the earnings growing like this? The market says, whoa, why are we paying 50 times earnings for something that's growing at 20%? And here, though, the reason I say it's even worse than Walmart is because the price actually goes down for 2 or 3 years. And now it's moving sideways. What does it mean? Does this mean it's all better now? No, it doesn't. Because you still have the price going sideways while earnings are growing. Right? The multiple is still coming down, and you can see that we move the price ratio. So these growth stocks are wonderful vehicles, or it's easy to spot these growth stocks. Okay, it's easy to find when they're overpriced. You don't want to buy them when they're overvalued. Growth investors are very value conscious. They want to buy overvalued stocks. Worst of all, a troubled company. This is Eastman Kodak. It's Eastman Kodak. See the revenues are flat. And the earnings are going down. And the price cards are growth. Growth in price, always growth in earnings. Down too. And here goes the valuation. But every day, hundreds of people are buying these stocks. Now, what person in their right mind would buy a stock whose revenues aren't growing and whose earnings for 10 years have gone down? Growth in price follows growth in earnings. So, how do you deal with it? How does a retail investor deal with growth stocks? Very carefully, very carefully. One of the things we learn to teach people, is whenever you go into a stock, even with great ones, with long, steep, straight revenue range profiles and a price that doesn't look overvalued, whenever you do that, don't go in and buy as much as you can afford all in one trade. That's very heroic to do that. Sample stock. Okay? Take a bite. So you get focused on it. It gets on your portfolio list. Okay? Buy maybe a quarter, third, 20% of what you might ultimately put into a stock. And then wait and see what happens if that growth does continue. And if it does continue, buy some more. Average your way up. I think averaging your way up is the best, it's the most comfortable way to ever buy a stock. Hey, your average cost stock, if you're averaging up, your average cost is always less than the current price of the stock. You're always in the money. Isn't that comfortable? If, on the other hand, you bought a stock, you buy your first, you take the first bite, and then the earnings aren't there. The next quarter, the earnings aren't there. Or maybe the next 2 quarters, the earnings aren't there. You say to yourself, well, is this a hiccup or a cockroach? Okay? Is it just, just something very explainable why earnings are down in acquisition, write-ups, one square another? Or is this just the first of a series of bad quarters? If you think it's just the first of a series of a bad quarter, okay, you don't buy anymore, and maybe you sell the little bite that you had. You undoubtedly have taken a hit of 10, 20, 30% on that bite. But it's a hell of a lot easier, better, taking a 30% hit on a quarter of what you might have put in, and taking a 30% hit on the total that you might have put in. On the other hand, if you do believe it's a hiccup, and you go buy some more, take another bite. Take another bite. People don't like to do this, though. Why don't people like to do this? They have been convinced over the years that, geez, I don't want to pay commissions 4 times to buy into this stock. Right? And of course, the brokers discourage this kind of casual, gentle mind. They want you to jump in. They want you to trade lots, in and out, in and out. Take your 20%, if it goes up, sell it, right? You never go broke taking a profit. You've all heard that. Well, you never get rich either. Okay? You walk away from the great growth stocks. You walk away from the great growth stocks too early. Those are the ones you just want to have in your portfolio forever. Keep an eye on them. But after a while, they've split 2 for 1, 2 or 3 times. Your average cost is peanuts. Not lots of shares. And then you don't worry about it. Unless it gets overvalued. And then you start to lighten up. So, we couldn't find any. We have our stock selection guide in our magazine we used to teach people about finding these great stocks. And I could do that myself. I didn't need any outside help to do that. Thanks to page-making, the page-making software that came out in the middle of the 80s was fantastic. You can make it. But just to show people about these great stocks and the terrible stocks. But we couldn't do anything about making it easy, making it cheap for people to buy small amounts of stock. Okay, because the brokers and dividend reinvestment, of course, dividend reinvesting is key to building wealth over the long term because a big part of your return can come from dividends being reinvested. And so we went to brokers in the city and said, you know, like, who would do our trades for us and reinvest dividends for us? And they said, you know, we have to keep. We have thousands of customers. And the broker said, well, we'll do that. We'll dividend. We'll do the trades for you. Go $5 trade. It's not quite a few years. I said, well, isn't that great? What about them? But that includes your reinvestment trades. So we reinvest like 25 cents for somebody in their stock. They want us to pay $5 to reinvest 25 cents for thousands of people each. So we went out and created a back office that will keep track of little purchases of stock. They're remarkable. There's really no back office in Canada that keeps track of fractional shares of stock. If people go through us, they buy like $500 of the stock or $1,000 with 100 shares. You get rid with fractional shares. So, and no one has a back office that will keep track of fractions for stocks. They do it for mutual funds, but not for stocks. So we're going to create a system where people can buy their stocks, $50 a month or $100 a month or $5,000 a month. Some people buy $20,000 worth of stock a month. We also teach them to diversify, spread it around amongst 15 or 20 high-quality growth stocks. But the only way you can deal with the overvaluation is be cautious about building a position in the stock. Take a little stock, nibble at it until you're absolutely sure and you've got a high rate of giving you earn that this company's going to deliver for you in the future. So, coping with overvaluation, build your positions gradually. This is purchased over several months, quarters, and even years. I think the even years is the one that I can emphasize. Now, I love Jim Cramer's show. Most people hate it. I really hate it too, but I love him because he's so entertaining and he's out there with all these buy this, buy that, great stock, terrible stock. I've watched him a few times and I go and take his names. I go and take the names he mentions in the simple punch them into our software, which I'll show you and to see whether they look like great stocks or not, or terrible stocks. And very often they're terrible stocks. Very often they're terrible stocks. So what I'm going to show you now is how we study the stock. The stock's fundamentals, 7 fundamentals, to see if it is in fact a high quality growth stock. Okay, so I'm going to go back here for a moment. This is wonderful. Thank you. So I'm going to show you one of my I show you one of my favorite growth stocks. Been a big favorite of mine for years. Since about the middle 90s, we do workshops across the country, and we've featured Stryker Corporation as our example stock to study since 1995 now. So the data here in our software actually picks up from 1996 to 2006. But this line here was way back like that too. It was very steep and straight. This is the company's revenues, okay, for the last 10 years. And you can see how steep and relatively steep and straight they are. If you look over here at we do the numbers here. From 1996 to 2006, the average growth rate, the least squares growth rate, is like 21%. You can see, actually, there's been some slowing down in the growth of the revenues. But the company now has, like, I think almost $2 billion in cash. And the last time they had, sort of money, they went and bought one of the hip and knee, Stryker. Stryker's a hip and knee company, artificial hips and knees. I bet you if you know anybody who's, any of your friends or family got a hip or artificial hip or knee, odds are it's probably a Stryker hip or knee. There's 2 or 3 other guys out there who think these, but Stryker's certainly one of the leaders. Anyways, 7 or 8 years ago, they went and bought, I think it was Pfizer's hip and knee business. And that's why you get this big bump up in revenues, which you like. So you look at the company and say, oh yeah, it's growing at 20, it's slowing down its growth. In my first quarter of this year, 07, they earning revenues grew almost 13%. You see that's trend. I didn't think all of it, well, I'll show you. If we go and look at the fundamentals, data worksheet and the data, cash. There they are, $1.4 billion in cash. For a company that's produced revenues of $5 billion. When they get a lot of cash, they usually go and buy something. So, my expectation, and I am a forward-looking investor, George, is that the discoveries, we're going to see a bump up here in the future. It don't need to be done. It doesn't make a great deal of difference. I just, project future growth at 13%. The software defaults to the longest average growth period that's available. Sometimes you only have 5 years of data. So you just overwrite them. I'll project at 13 if you want to project at 12, 10, whatever. Be my best. So we're looking at the company's revenues. What do you need to grow revenues? What are most manufacturing kind of companies to grow revenues? You need assets. You need assets. You gotta have the inventory, maybe a plant to make stuff and whatever. So when we make this judgment about the future growth of the revenues, we look at the fundamentals, and the first fundamental we look at is the company's retention ratio. Is what part of the earnings do they keep in the business to finance growth? You see, they keep around 90% of the company's earnings in the business. And you sort of like that. It's a growing company, right? So the easiest source of money to finance that growth is your retained earnings. The second source of money is what? Borrowing. So you look at Stryker's, we call it equity efficiency. It's reliance on debt. Total assets divided by total equity. And what you see here is years ago, when they did that acquisition that I showed you in the revenue profile, they had $1 billion of their own money. They went and borrowed $1 billion to do this $2 billion acquisition. And so their debt shoots up, right? And then what do you see? What do you see that's beautiful? You see them paying down that debt. 5 years later, they're back to where they were. We've got the average growth in those earnings over the last 10 years at 25%. See, look, has been in the 20s, very consistent until just the last couple of years. Okay? And it's slowed down a little bit. I'm going to make a projection. I've seen the other fundamentals. This looks like, I'm going to grow 15, 18, 20%. You have to make a judgment, George. Whatever. Well, for the foreseeable future. I'm looking at 5 years, George. I'm hoping this stock is going to double in 5 years. That's a 15% rate of return. Okay? And that's fine with me. I'll be happy. That's a lot better than you give me a bank rate. So make a judgment. But make a judgment. Of course, we tell people that once you've found a company, a great company, with long, steep, straight revenue profile, and they have good fundamentals like I just shown in terms of reliance on and debt ratio, and efficiency of revenue profits, and so forth. You go read all, you spend as much time as you want studying that company. Read the annual report. Get an analyst report. Check every ratio in the world. And in the meantime, make a judgment. And that will help you make more informed judgment. So here we're going to grow, say, 18%. That's in 1 year. They're going to have the company for 1 year, but they're going to do that acquisition. I don't know that they're going to do it, but I think they're going to do it because they've done it in the past, but they haven't some money and low debt. So now we have the model of a pretty good fake book. Let's check the pricing. Let's check the pricing because the valuation. Because I don't want to buy something overpriced. So here's the company's earnings for the last 10 years. See how they've been growing with the green line. And here's the company's high and low price bars, these blue things here. And we calculate the high and low price earnings ratio. So we have the high price and low price, and we anchor that high and low price bar right on top of the earnings for that year, so that we can see if price bars are growing faster than the earnings profile. We can change that anchoring, and I'll show you how we do that. But here it is not really necessary to change the anchoring. So what do we see? Tracking along pretty good. A little bit off, the price bars a little bit faster than the earnings, but comes back. It goes up again, a little sideways move, and still going up. High price is still going up. See, there's been a fundamental, see how the price bars are sort of all above the earnings profile. What that means is there's been what's known in the trade as an expansion in the multiple. Well, why does a multiple expand? Well, it expands for a number of reasons, but one of the main reasons is that more and more people learn about the story. This is a great story. What's the story on the hip and knee business? What's the big picture, the big selling point in the hip and knee business? The baby boomers, right? There's this huge cohort of them coming through. All these hips and knees because they've kept so fit all those years of running and doing all that stuff. Their hips and knees like they're going out of style. Okay? So people are saying, yeah, gee, that's a good idea. Look at the multiple. Multiple got to $52 for a dollar earnings. The high price. What is that? Back in 2000. Okay, yeah, see, comes down, keeps going down, keeps coming down. And you see here's. So there's been this multiple expansion. I get rid of that if I go like that. I take out that old multiples in back here. Let's see that 35 and 18. All the others are 40s and so forth. That's an outlier. You call that an outlier. Okay? So there you go. You've got the price bars tracking along nicely with the earnings profile. Except for what? Except for what? These three. Earnings are growing a little bit slower than in the past. And what's happened to the price? Not going up. The high price is not going up. Right? Is this another Walmart? Is this the start of a Walmart? I've owned this stock for a long time. And I've enjoyed owning this stock for a long time. And I saw this happen a couple of years ago. Oh, it moved sideways this year. Earnings grew and moved sideways. Okay, I like that. That's been a good friend. So I'll stay in for another year. Then move sideways again. So this is December. This is reported. This is last January. This is past January. So I said, there's like three sideways. 2 years of moving sideways. Maybe I'm going to like that. So I'm going to sold a piece of my strategy. And here it is. I see now up to $67. And I sort of say to myself, well, John, China sold it. And this is that token. Stryker's an old story now. Okay? The world knows about Stryker. So I get rid of a little bit now. That's fine. It's going up. It's going up this year. Hopefully it'll continue to go back. And I just will continue to own what I own. So. But this is we have to imagine now, George. You have to imagine the price for these earnings in 5 years. Remember, we did a projection here. We grew earnings out at 18%, which makes earnings in 5 years $4.62. Okay? So what's the valuation of those earnings going to be 5 years from now? We look at the price where we see the valuations going down. The recent valuation, though, look, The high price so far this year has been $30 for a dollar earnings. And the low's been $21 for a dollar earnings. And currently it's 28. So we sort of have a guideline, and it would be unusual to use to project price earnings ratio greater than 20 for a growth stock in 5 years. Not a bad rule, actually. So what is it? The valuation could be around 20. Could be 22, could be 18, whatever. But I'm now going to price, I'm going to multiply that valuation, my earnings growth at 18%, producing this $4.62, times this multiple of 20 times earnings. And I'm going to create what I call an upside price. $4.62 times 20 multiple. Good. Looks like a $92 price in 5 years, which translates into about a 6.5% rate of return. And I say to myself, oh, gee, I'm sort of glad I got rid of that piece that I did. Because going forward, if my pessimistic growth expectations are valid, then people are going to come to realize that, gee, what should we be paying? Why should we be paying 30 times earnings for a 6% rate of return? But, and we go on to just do some, we look at the downsides and say, well, how am I wrong about this? How wrong am I going to be? And you sort of start out with, well, you got to count on stock dropping by at least 20% after you buy it. So that gives you, that winds up with a low price for the stock. When the high price for the stock was $92, we get a low price for the stock, $25. Sorry. Low price, $53.90. So I've got $13 of downside, $25 of upside, $4. I've got only $1.86 as reward for $3 of risk. My goodness. Well, that's all. But one of the things you always want to do, of course, is test the sensitivity of your rate of return here to your projections. Now, I'm using 18% to grow earnings. If the company does do an acquisition with all the cash it has, it will easily be 20 because you'll have a big amount. And the multiple, I'm using a multiple of 20, the market currently is using 30. If I bump that to 25, just to be one of the boys, good. 13.6% rate of return, which is not bad. This is not a high-risk business. Why isn't this a high-risk business? Because that earnings profile is what? Straight, consistent. Growth slowing down a little bit until we do an acquisition. But year after year after year, the team here at Stryker does a great job producing new products, new improved products, and converting those sales into profits. Profits, mind you, they're growing faster than revenues. Right? Revenues are growing at about 12 or 14%. Profits are growing at 12%. To grow your profits faster than your revenues, it's remarkable again. Remarkable. So there you have it. Stryker as a sell or Stryker as a buy. I'll leave it for you. So this is how we study stocks. We find a high quality growth stock to have in your portfolio. My goal in life is to have a portfolio of 20 of these Strykers. That's the goal. Okay? They don't all, you put them in, they don't all turn out that way. I just started on a couple of new stocks in the last 2 days. Taking little bites of stocks that happen. Going to be good stories in the future. But it's just a very gradual way. And unfortunately, the retail investor has been taught to be in a hurry to buy and sell. And people who do that ultimately don't. So, in the handout book, I said that there would be an opportunity to show you guys some samples. You can ask me to show you what any company looks like if you know the symbol. So go ahead.
Bank, please, R1.
Oh, well, that's good. You made a good choice. You made a good choice. We'll see what I did there. That's R1. We just did our magazine. We just did all the Canadian banks. We went through the big top stocks. Royal was by far the best. growing structure of time. But here's the revenue profile, growing at about 10%. You'll see it slowing down too. You know, the bigger you are, the slower the growth rate is. And that's why Walmart. You know, one with the price prices one sided. Why do the price prices one sided? Because people know that Walmart can't keep growing at 10 or 12% a year. When you sell $350 billion worth of stuff a year, to grow at 10%, you've got to sell $35 billion more. 90% of North American companies don't sell that much in their entire business. So here's the revenue profile, earnings profile. Look at, you really like this little squiggle up here last year, okay? And first quarter this year is at 28%. So just look at the stock. Question is it on sale or is it, overpriced? We look at it and see this is anchored way back here. And if you look at the multiple, 10 years ago the high multiple was 15, 16, 15, 13, 14, 15, 15, 15. Very steady multiple. So I look at it. If you extend that profile this year, it's going to run into that price point. Top end. So again, you want to start a position well, take a little bit. So I'm not going to do any judgments here. It looks like a great company. So we can have that. Any other ones? Sorry?
Express GS.
EXRS?
ES.
Well, I want George to give me one of his value stocks. I want George to give me a name for one of his value stocks. Well, there's the revenue. You see them climbing out? We sort of don't like that, do we? Nice looking earnings, though. Nice looking earnings. Look at that rate of growth, 34%. Got a little slowing, but still, growth at 10 years for 34% is remarkable. Consistent growth like that, remarkable. What about the price? See this big slide here? What happened to the multiple? See the multiple, 30 to 50 to 60. See how growth, the valuation got out of whack? And then it came down 43, 39, 25, 20s. Now it's going back up. Following up and it's around 30. But this year, so far this year is 22. And we're on 22. So I might just, what I normally do here after the slide, I re-anchor this thing after the slide because this is when the valuation changes. And it looks like the current price is right on the projection. The default projection is 34%. Last year they grew at 25, so I wouldn't go at much more. I'll go at 20. And you see, still a reasonable earnings up. What are earnings up? 48% this first quarter. Interesting. I want to spend some more time reading the chairman's report and reports so well. We buy it from a third party. But any other suggestion or questions?
Korea, New York, it's MO.
Is that the cigarette guys?
Yeah.
Not much of a revenue growth profile, is it? Well, look at that. You'll like that. But let's see. Earnings not bad, 7% growth. Not a growth story. Not a good story, a reliable growth. But it's not 15% or 20%, which we want to see. Price bars. Well, you've been in this stock for the last 10 years. Those years, starting in 04, dead money. But see, a little rise here. Cigarettes are destined to be old-fashioned. You wouldn't buy stuff like that. Just because of that big picture issue. Yes, sir.
Fairfax.
Fairfax. What is that, half that page? There we go. Sure you want me to do this? There's, been run up the revenues till the end of the last century, and then sort of sideways down, a little peak up here. It's a little erratic. Not just straight, long, steep, straight, but us retail growth investors. Look what the That's tough. That's tough. Well, now this, my view on value investing is that retail investors have an advantage over the big institutions, okay? Because we don't have that much money that we have to spread our money widely around the whole index, okay? The average retail investor guy, hundreds of thousands, 2 million, whatever, okay? You're not going to become an owner of Canadian Tire, Loblaws with that money. So he doesn't have to worry about the position. So he can just restrict himself to the relatively few great companies that are out there, great stocks that are out there. The institutional investor, on the other hand, got a pot, got a ton, okay? He can't possibly put it all into the 100 or 200 great companies in it's too much money, and you got lots of those guys. Well, billions and millions. So they got to spread it around to the value stocks, those tough ones. And CFA, you can have 5 of those, I think, and still have trouble with. Because when with Stryker, when we were imagining the growth in the future revenues and earnings for the hip and knee business, we all know about the baby boomers coming through and so forth. And so you imagine, no one said, oh, John, you can't project at 18%, that's a silly number, okay? You can't. It's a reasonable number, 15%, reasonable number. Now, so if you want to project out 2006 here, 5 years in the future, what's the growth rate? I can't. This is beyond anybody. As far as, except insiders. Insiders could know what's going to happen in the next few years. They could change things around. But for the average guy on the outside looking at this, you say, well, I could bet on this, but it'd be useful for you. You can put your money on and say, I hope this doesn't next year go down again like it did here and here. So, but the value guys love this stuff. Go to it.